Hey everyone, welcome back. If you've been watching the silver market lately, you already know something extraordinary is happening. But what most people don't realize is that the price action we're seeing right now isn't the main event. It's the warm-up act. The real story of 2026 isn't just about silver going up. It's about a supply shock that has been building for years and is now reaching a breaking point that will force a complete repricing of the metal. Let me be direct. When I say $300 silver isn't speculation, I'm talking about basic arithmetic, industrial demand that cannot be ignored, mine supply that cannot keep pace, and a physical shortage that derivative contracts can no longer paper over. This isn't about hype, it's about math, and the math is screaming. Here's what nobody wants to talk about. Silver has been running structural deficits for 3 consecutive years, not minor shortfall. We're talking about 200 million ounces of annual demand that exceeds what mines can produce. That's roughly 6,000 metric tons disappearing from available supply every single year. And 2026 is shaping up to be the worst deficit yet. Where's that silver coming from? Above-ground inventory, recycling, ETF liquidations in prior years. But here's the problem. Those sources are drying up fast. COMEX-registered silver inventories have dropped to levels not seen in over a decade. London vaults are being drained. Shanghai premiums are signaling physical tightness in the world's largest silver market. The buffer is gone. And unlike gold, you can't just decide to hold off on using silver. Solar panels need it, EVs need it, 5G infrastructure needs it, AI data centers need it. These aren't discretionary purchases. They're locked into global infrastructure buildouts that have already been funded and committed to. The silver must be sourced. There is no substitute that works at scale. Let's zoom in on solar for a moment because this is where the supply shock gets really interesting. Every single solar panel requires silver, roughly 20 grams per panel on average, though some advanced panels use even more. Global solar installations are projected to exceed 500 gigawatts in 2026. That translates to over 3,000 metric tons of silver demand just from solar alone. Now here's the kicker. Governments around the world have committed trillions of dollars to green energy transition. The U.S. Inflation Reduction Act, the EU Green Deal, China's carbon neutrality goals. These aren't flexible targets that can be dialed back if silver gets expensive. They're legislative mandates with deadlines and penalties. The solar panels will be built, the silver will be consumed, period. And solar is just one piece. Electric vehicles are using more silver per unit than traditional cars. 5G networks require silver in virtually every connection point. Military applications are consuming record amounts for advanced electronics and defense systems. This demand isn't cyclical, it's structural, and it's accelerating. So if demand is surging, why don't miners just produce more? Great question. Here's the reality. There are almost no pure silver mines left. Roughly 70% of silver production comes as a byproduct of copper, zinc, lead, and gold mining. That means silver output is largely determined by the economics of other metals, not by the silver price itself. Even when silver hits $100 or $150, a copper mine doesn't suddenly produce more silver. The geology is fixed. The ore grade is what it is. And most importantly, it takes 7 to 10 years to bring a new mine online from discovery to production. You can't just flip a switch and get more supply. Primary silver mines face their own challenges. Ore grades have been declining for decades. What used to yield 300 grams per ton now yields 150. Energy costs are soaring, labor costs are rising, permitting timelines are getting longer, environmental regulations are getting stricter. The cost curve for new silver production has shifted dramatically higher. Translation? Even at $300 silver, the supply response will be limited and delayed. By the time new production comes online, the deficit will have compounded for years. We're not talking about a temporary squeeze. We're talking about a multi-year structural shortage that price alone cannot quickly fix. For years, silver pricing has been dominated by paper markets, COMEX futures, London forwards, unallocated accounts. These instruments allowed banks and institutions to create synthetic supply that kept prices suppressed even as physical demand outpaced mine production. But that illusion is breaking down. We're seeing unprecedented delivery requests on COMEX. In previous years, most futures contracts rolled forward or settled in cash. Not anymore. Buyers are standing for delivery and demanding physical metal. The registered inventory available for delivery has plunged while open interest remains elevated. That's a recipe for a delivery failure. London is experiencing similar stress. Allocated gold and silver accounts are being preferred over unallocated. Clients are asking for their metal to be segregated and stored outside the banking system. The trust in paper claims is eroding, and when trust erodes in fractional reserve systems, you get bank runs. In this case, a run on physical silver. China's export restrictions have made this worse. Beginning in 2026, strategic metals, including silver, face new licensing requirements for export from China. This fragments global supply chains and reduces the ability of Western markets to import silver from the world's largest producer. Physical metal is getting trapped in jurisdictions where it's mined or refined. Let's do the math together. If silver needs to reach equilibrium between supply and demand, price has to rise enough to either destroy demand or incentivize new supply. But we've already established that demand is largely inelastic in the near term, and new supply takes a decade. So how high does price need to go? Look at historical ratios during previous supply crunches. In 1980, silver briefly touched $50, which would be roughly $180 in today's inflation-adjusted terms. But that was before EVs, before solar at scale, before 5G, before AI data centers. The industrial demand base is multiples larger now. Compare silver to other critical materials in shortage. Lithium spiked 400% when EV demand surged. Palladium hit record highs when auto catalyst demand exceeded supply. Uranium doubled when nuclear buildouts accelerated. These aren't anomalies. They're what happens when inelastic demand meets constrained supply. Silver currently trades at roughly 1/6 of its inflation-adjusted 1980 peak. If we adjust for the expanded industrial demand base and the structural deficit, a move to $300 would still leave silver undervalued relative to its fundamental scarcity. This isn't irrational exuberance. It's reversion to scarcity pricing. Something else is happening that's flying under the radar. Institutions are starting to pay attention. Sovereign wealth funds are adding silver to strategic reserves. Pension funds are exploring commodity allocations. Family offices are buying physical metal directly, bypassing ETFs. This matters because institutional capital moves in size. When a pension fund decides to allocate even 1% to silver, that's billions of dollars of demand hitting a market that trades relatively thin compared to gold or major currencies. The float of available physical silver is tiny. A few large buyers can absorb months of mine supply. We're also seeing billionaires publicly disclose positions in silver miners and physical holdings. These aren't speculative traders. They're long-term capital allocators who have done the fundamental work and concluded that silver is mispriced relative to the coming supply crunch. When smart money moves this decisively, it's worth paying attention. What happens at $300? Let's play this out. Silver hits $300. What happens next? First, some industrial demand will be destroyed. Manufacturers will look harder for substitutes, use thinner coatings, redesign products, but this takes time and won't happen overnight. Second, recycling increases. Old solar panels get recycled more aggressively. Scrap dealers pay more attention to silver-bearing materials. But recycling can only provide a fraction of annual demand, and much of the silver in use is effectively unrecoverable for decades. Third, exploration accelerates. Junior miners get funded. New projects get greenlit. But again, this takes years to translate into actual production. The lag time is long. Fourth, investor demand could actually increase, not decrease. If silver is rising due to a genuine supply crisis, investors pile in as a store of value play. This is what happened with lithium. Higher prices attracted more investment capital, which pushed prices even higher before supply finally responded. The bottom line? $300 silver doesn't solve the supply problem quickly. It simply reflects the reality of that problem. And if the deficit persists, $300 becomes the floor, not the ceiling. Here's what makes 2026 different from every prior year. The Shanghai Gold Exchange, which also trades silver, is increasingly setting price based on local physical supply and demand rather than following Western futures markets. We saw this in late 2025 when Shanghai silver traded at significant premiums to London and New York. When Eastern markets reopen fully in January 2026 and physical demand reasserts itself, we could see a permanent pricing dislocation. If Shanghai consistently trades above Western prices, arbitrage will drain metal east, Western vaults will empty, and at some point, COMEX in London will be forced to reprice to match physical reality or face delivery defaults. This isn't theoretical. We've seen this movie before in other commodities. When China's domestic demand for copper exceeded global supply, London copper prices followed Shanghai, not the other way around. Silver is following the same script. The East has the demand. The East has the refining capacity. The East will set the price. Walk into any investment conference and ask about portfolios. You'll hear about stocks, bonds, real estate, maybe some crypto. Almost nobody is positioned for a commodity supply shock. Silver is an afterthought if it's thought about at all. That's the opportunity. When a fundamental imbalance exists and nobody is positioned for it, the repricing is violent and swift. We don't get a gentle climb, we get gaps. Limit moves, shortages, panic buying. This is how supply shocks manifest in real time. The smart move isn't to wait for confirmation. By the time CNBC is running headlines about silver shortages, the metal will already be $400 and physical premiums will be prohibitive. The smart move is to understand the math now and position accordingly. I want to be clear about something. This isn't a replay of the 2011 silver run. That was driven primarily by investment speculation and monetary fears post-financial crisis. This is fundamentally different. This is a physical supply crisis layered on top of monetary expansion. In 2011, industrial demand could be ignored. Mines could ramp production. Scrap supply could flood the market. None of those relief valves exist today. The deficit is real. The demand is locked in. The supply cannot respond quickly. When you combine that with central banks expanding balance sheets again, sovereign debt at all-time highs, and geopolitical fragmentation, you get a perfect storm for hard assets. Silver just happens to be the hardest asset with the deepest supply problem. So yeah, $300 silver isn't crazy. It's math, and the math only works one way from here. The supply shock is coming. The only question is whether you'll be positioned for it or caught off guard. Do your research, run the numbers yourself, and make your decision based on fundamentals, not headlines. Because 2026 isn't about predicting the future. It's about recognizing what's already happening and understanding where it leads. The supply shock is here. The repricing has begun. And $300 is just the number where supply and demand might finally start to balance. Thanks for reading. Stay informed, stay positioned, and I'll see you on the other side of this historic move.